very helpful in facilitating a consensus at the G7 on the weekend. I mean, the Biden administration and Secretary Yellen took a very constructive approach to multilateralism, helping to unblock what had been a difficult dossier up until that time. But of course, I mean, ultimately all countries that are part of an agreement, an international agreement, ultimately have to work these issues through in their domestic context, including in the context of their parliaments. And I mean, that is obviously something that we hope the US will do in its own time in the appropriate way.
Matthias, G7 agreed to a minimum, at least, of 15%. Could you see that tax rate going above that 15%?
Well, look, it's important to ensure that we strike the right balance. I mean, the average across the OECD, the average corporate tax rate across the OECD membership at present sits at about 21 to 22%. There are some countries that are below the 15%. Quite a few of them are above the 15%. I mean, if we were able to achieve a circumstance where all multinational companies operating globally are required to pay at least 15% on their profits, I mean, I think that is a very significant step forward. Of course, there is still then space for the appropriate competition between different jurisdictions based on their fiscal policy settings and their tax mix in their respective jurisdictions.
Matthias, there's still a lot to do, as you were mentioning, and Tom was referencing how U.S. legislature may end up taking a lead role in what exactly this looks like. What are the main hurdles that you see in the ongoing negotiations as we head into G20?
Well, look, I mean, clearly, I mean, it's very important to have all of the G7 countries reach that agreement. But of course, I mean, we need to expand, the level of agreement, well and truly beyond the G7. And that's what the inclusive framework process will do with more than 100 countries and jurisdictions involved. And indeed, I mean, around the G20 table, you have a significant number of other large economies around the world part of the process. So, I mean, I'm quietly hopeful, quietly optimistic that ultimately, when it's all said and done, we will be able to reach an outcome, in the next little while.
Matthias, on the tax plan, though, can we go back to this idea here of when you're setting the revenue threshold here? There's been a lot of talk about how complex this agreement is or how much it will be, and the idea that companies will sort of be able to find loopholes to get below that $20 billion threshold or whatever the final threshold may be. How do you ensure that companies aren't going to find an end run around that with regards to the revenue component of it?
Look, I mean, you're now going well and truly into the weeds of, technical, implementation arrangements. I mean, I think the principles are very clear. Companies, large companies that are generating significant profits in markets around the world, digital companies, but also other large companies, should be required to pay their fair share of tax in the markets in which they generate those profits. I mean, the combined effects of the globalization and the digitalization of our economies has meant that it has been possible for quite a number of large companies not to pay or to pay very little or not to pay any tax at all in many of the markets they operate. And that is just a matter of fairness and public confidence in the way our taxation system works. And that is something that the proposal agreed to by G7 finance ministers on the weekend would address.
Matthias Cormann, I am absolutely fascinated as your selections through the nominating process. Many of the other nominees for OECD are people very familiar to Bloomberg surveillance. They've been great help to us in our coverage internationally over the years. You are a different OECD Secretary General, and I want to go to your Australia, your Western Australia, and the idea of the debate over big, evil American tech companies. Maybe it's tangential to OECD, but this is going to be be in the crosshairs. The fact is, Amazon out at the Perth airport has been a massive job creator for Western Australia. From where you sit with your finance work in Australia, and now you move to Paris, how do you dovetail? How do you fit together the European fear of American big tech with the reality that create jobs like at the Perth Airport Fulfillment Center?
Well, firstly, there's 38 member countries of the OECD, and the one thing that joins us all together is that we are all market-based democracies, and we are all committed to generating opportunities for the people in our countries to get ahead based on free market principles, and indeed, based on democratic principles and in the context of rules-based global trading systems. So I think you'll find that the things that we have in common are much stronger than the variances between different parts of our membership. Now, I bring to this job about 7 years' experience as the Australian finance minister, but I also bring to this job, my background as somebody who grew up in Europe, went to school and university in Europe, and so I guess the membership felt that I had a particular contribution to make, and I look forward to making it.
This has been wonderful. Matthias Cormann, congratulations as the new Secretary General of the OECD. Absolutely fascinating there to see. Lisa, just to me, just a stunning selection over the coming out of post-World War II OECD selections.
I'm curious about your question about Amazon. I thought it was a really good question. Well done.
I did okay there?
You did great.
Okay, can I go home? Okay.
Go ahead. No, honestly, you can go to space with Matt Miller. There's a question going forward about how much cooperation there actually can be, given the fact that a lot of European countries want to go after U.S. tech companies, and then you have the likes of Ireland who are, basically benefiting from low tax regimes. How are they going to get on board with something that could potentially undermine that status?
Here is just so much, and Romaine Bostic, this goes back to David Kostin's research at Goldman Sachs here. There's an overwhelming issue of big cap America tech, and that is their investment. Their capital expenditures worldwide are stunning. Americans need to know what Amazon's doing in Perth, Australia.
Yeah, and look, the OECD gets a lot of credit for pulling all this data together, but I think some of the complexity of actually implementing this is I think, also a little understated right now. It'll be interesting to see if they can wrangle all these countries and get them on board.
Well, understated is the red and the green on the screen. We've got a Dow that's elevated, SPX off fractionally, negative one. I'm going to call it. We start the week strong in equities after that jobs report that we saw on Friday. Brent crude 71.69. Stay with us on radio, on television.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Consumers have lots of money in their checking accounts. We think they spent about 65, or they have not spent about 65–70% of the last couple rounds of stimulus. Loans are starting to pick up. There's plenty of borrowing capacity. Companies have unused lines.
Brian Moynihan holding court on CBS Face the Nation there. Believe it, over the weekend they were giving out free air conditioners at Bank of America branches across
that was 40
the
years
nation.
ago.
For those of you internationally, is a steamy and hot weekend for most of America as well. We're all moving to Seattle. I guess they had a more cool, calm, and collected moment. Lisa, David Wilson came in and said, I'm doing something for Abramowitz. I mean, he really doesn't care about me. Lisa, this is way too complex for me. It's about the Fed, it's about bonds, and it's about exchange-traded funds. Lisa, I'm lost.
Well, the quiet move that the Fed made when it was going to unwind its nearly $14 billion portfolio of corporate credit holdings, including a large proportion of ETFs. Now, this really didn't move markets, didn't come as a big surprise. It's not that big of a number. However, it is a big component of the exchange-traded funds that a lot of people use as the quick way to get in and out of credit markets. Dave Wilson's been tracking that. And Dave, it raises a question. If it's not market moving, what is the consequence of the Fed's policy? And can you give us a sense of how big their presence is in the ETF world?
Well, it's going to be something to watch in terms of, can they get out and kind of leave the ETFs kind of unscathed in terms of their value. I mean, you're talking about 16 exchange-traded funds, holdings of more than $8.5 billion total. And maybe the one to watch is the iShares iBox U.S. dollar corporate bond ETF, the ticker LQD, because the Fed is the third largest holder of that ETF at a 6% stake, and it's their biggest single position at $2.4 billion.
Okay, stop. We got to explain this to idiots like me. Jerome
LQD.
Powell owns 6% of that ETF.
Well, Powell and the governors on behalf of the American public own 6% of the shares of that ETF, yes.
Is that a lot?
Well, I mean, when you look at the numbers...
Am I outraged? I mean, really? They own 6%?
Yeah, absolutely. I mean, we've got all the figures on the Bloomberg terminal in terms of holdings. And, you're talking about the second biggest chunk when you go through these 16 ETFs. There's another one at the top of the list. It's the Spider Fund, intermediate term, Spider Portfolio intermediate term, where they have a 7.2% stake. And you think about it, the bigger the holding, the more of a risk that when the Fed gets out, it affects the market in a meaningful way.
Romaine, this brings up the question, how much does the Fed own of AMC?
I hope zero. I think if we find out that they do own it, I would be a little bit worried. But you talk about LQD here, VCSH. I'll talk about junk too, because I mean, they did actually sort of support I guess what can be considered the low end of the market, though it did actually seem to outperform, at least while the Fed was holding it here, Dave. Is there a general sense here that whatever the Fed puts back out on the market here, that's going to have any material effect on the pricing of these ETFs?
Well, they're going to try very hard not to have any effect as they get out. And when you talk about high yield, I mean, sure, the Fed's in 7 different high yield ETFs, but you're talking about a much smaller percentage of the overall investment, a little more than $1 billion out of $8.6 billion as of last week. So, I mean, sure, it's a piece of the puzzle, you might say, but it's not the biggest piece. It's really the investment grade ETFs where you've got to watch to see if the central bank getting out does have an effect.
Tom, if I were you, I would say stop the show and give a perspective here on why this is important, because this is actually incredibly important.
Discuss
you remember,
why.
Back in March 2020, the Federal Reserve took an unprecedented step to come and support the credit markets, to directly buy corporate debt through ETFs and directly. A lot of people derailed this as basically a move into moral hazard. Basically, what does this say to corporate borrowers that if there is a trouble period of time, the Fed's going to come in, back you up, and lower your borrowing costs? Now the Fed is coming out and saying, look, we're done. We've done our job. And there hasn't been a market movement. The takeaway here is the Fed has successfully used this tool to affect prices, because prices surged after they announced this program. Yeah. They're not coming down after they announced their unwinding of it, which indicates, frankly, that it's been a success and it will be a tool going forward for them.
Well, Lisa, thank you. And David Wilson, thank you as well. In a spirited conversation, I have no clue what we talked about there. Romaine Bostic, Michael Purvis in the 9 a.m., and he's out with a blistering headline this morning. Romaine, I think this really speaks of Q3, Q4. It's not that he's bullish, but he's maintaining non-bearish. We're hearing that from a lot of people. They're really not bullish. They're just non-bearish. I love that. He's non-bearish.
Well, it's called meaning that they basically have to be invested. I think you get a lot of that sentiment, maybe not as well articulated as he put it, but I think you can see a lot of people in this market right now that feel like you have to be in this, that this isn't a market that's really going to crash. It's not really clear whether it's going to continue much higher as well, but there are gains to be made. And if you're a portfolio manager, if you're a market strategist, you basically have to be invested at this point.
I mean, Lisa, you're non-bearish. I mean, Abramowitz is non-bearish, right?
Let's not get carried away. There is, though, this idea here of Yuri and Tim are talking about the death of the 60-40 portfolio. You can call me non-bearish.
Is that still dying?
The pendulum of non-bearishness.
It is.
There is a question, though, going forward about, just whether you have an irrelevancy of the 60-40 portfolio or whether it consistently performs that way. Michael Purvis basically saying you can't abandon it, right? And that actually is important.
Well, it is. I mean, Romaine, discuss this, please. The pendulum of non-bearishness, I think, is where we are. I mean, we're making a joke about it, but it's serious.
Well, it is serious. And I mean, back to the 60-40, I mean, a lot of people have abandoned it. I mean, you still have some folks who will sort of talk about the general idea that you kind of maintain some exposure, of course, to that fixed income space. But as far as the 40, I mean, that 40 is now morphed into something well beyond just, I guess, traditional treasuries, traditional fixed income, and a lot of, I guess, quote unquote, alternative assets are now in that 40. So, I don't know. I think it's just a new era for investing, and I think Purvis's comments seem to address that.
Let's discuss it right here. Simon Constable, which I think the essay of the year, the Wall Street Journal on investing, talking about rebalancing. Romaine Bostic, does rebalancing work?
I don't know. I think I'll stay away from that one.
There'll be a quiz in the 10 o'clock hour.
I think rebalancing works depending on what your objective is for rebalancing. As far as its broader effect on the market, I would probably.
Lisa, what do you think?
No.
If you want a non-answer, the pendulum of rebalancing. What do you feel about it? The pendulum.
I think everybody knows. I think it's total hot air.
Just throw words out. I do want to just note this. Michael Purvis will be joining another property on Bloomberg Television at 9:30 a.m. Eastern.
Oh, is that
we
we
can
brought
ask
this
all
up.
about non-bearishness pendulums.
Yeah, I think KKR is going to do an LBO for the Faro property.
I think, look, this is an important point because people, and it goes exactly, Tom, to what you opened the show with, this idea that 157 on the 10-year Treasury yield, a new paradigm. We're talking about something different right now than we were the 162.
Well, we were, but
Do you know I hosted The Real Yield on Friday?
Are you hosting?
Did you not
The Real
watch?
Yield? Please.
I just assumed you were at home watching.
I was in the heart of the surveillance now. What I want to know on a June morning is does Tang have an expiration date?
You tell us. You're the only one drinking it, let me tell you.
Tang Mimosa's a little flat this morning. Stay with us. David Riley next on radio, on television.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
recovering very quickly, but a lot of people aren't coming back into the jobs market.
People will get more comfortable coming back to work, but they're demanding more wages to do it.
The bottom line, though, is we're getting a big spike in inflation.
The market's a little too complacent about the Fed not even talking about tapering.
It's hard for the Fed to maintain the degree of accommodation when the output gap is closing fairly rapidly.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The pendulum of a summer stasis. Good morning. Tom Keene, Jonathan Farrow, Lisa Abramowitz. John Farrow off today. Romaine Bostic very much in from dawn to dusk, burning the midnight and the dawn oil. Always here. We very much appreciate it. Tom, the longer that you give markets right now, the more they want to go up, even if there is news to push them down. Yeah. And that is what we're seeing this morning.
The Friday read and the Friday gloom was really colored by being right near record highs. I mean, this is a market where the gloom crew is begging for the markets to go down. And I'm sorry, the bid is there. Is it there every day, Lisa? No. But the bid is there pretty much. We just go a little green on the screen here on SPX moments ago.
Yeah, it really definitely seems to be the momentum. And Romaine, even as you see the momentum heading into the close, it seems to be up as well. I'm wondering what the participation is like. In other words, who you have a sense of that's driving this trade.
Well, I think you're starting to see some of the institutions come back in. Remember, a lot of them had moved to the sideline because of that volatility. With the volatility tamped down a little bit, you saw the volume start to perk back up here. And you also start to see a bid come back into, I guess, would be some of the more traditional growth and momentum names rather than some of the, I guess, more speculative names, if you will. That's why Friday you did see the S&P 500 tick above that all-time high. It failed to close there, but that was driven by your Microsofts, Apples, and I guess the more traditional growthier and to some extent value names.
And I think that, Tom, really a lot of this is underpinned by the Treasury market, right? I mean, inflation very much front and center. And the idea that we have some sort of stability that seems to be consistent regardless of the data, regardless of some of the Fed speak around tapering, seems to underpin this melt up kind of feeling. Nothing has changed.
Yeah, but it's a melt up, but I don't know if that's the right, is there sort of kind of like melt up? Maybe that's where we are. I mean, double digit returns, but I'm just looking at, there's a bid on equities and the backdrop here is you're telling me the yield should be 162, 165, 168. We hear out to 185. Some people talking 2%, and we're at 1.5772%.
And if you look at the real yield, it's basically the same too. I mean, it's not really increasing either. And it really raises the question, Tom, about if you do get taper talk, what does that do to yields? I mean, honestly, do you end up with actually lower yields because that stymies growth?
The only one expert on this is Romaine Bostic, sitting in for Jonathan Farrow here on Friday on the real yield. I look, Romaine, at where we are on the inflation-adjusted yield, and I wonder about inflation-adjusted equities. SPX flat, a little bit green. Dow futures up 48. Yeah. Now, look at the VIX, folks, to me is just extraordinary. 21 down to 18. Yeah. And then we grind down, and right now, 15.79 on the VIX. Romaine, that's a wow statistic.
Yeah, that's a wow statistic. When you pair that sort of drop in the VIX with the drop in the dollar, and then the re-embrace in treasuries here, and then fold that over with the fact that you still have an equity market, at least at the top line, that's right around record highs. The question is, what does that tell you? And I think what it tells you is this becomes now a story about duration, not only duration of investments, but really duration of the timeline of when folks start to think that the Fed might move. Right now, that's still pushed deep into 2023 before you start to see some sort of meaningful move.
To finish up on the markets, Euro 121.67, excuse me, and yen showing some yen strength, 109.25. Right now, David Riley joins us. Chris Verone, the technical analyst, just published moments ago with Strategas, and he simply says the ex-United States opportunity set grows. Verone looks at surprising technical strength in Brazil and Italy. And Mr. Verone is on the same page as the good David Riley, chief investment strategist at Blue Bay Asset Management. You distill it all, David Riley, and you say EM debt is of acute interest. Why?
Well, I think in an environment where we have these extraordinarily low yields in developed markets, and you've just been talking about a negative yield on U.S. Treasuries, then I think it's natural to look where you're getting not only a higher yield, but where you have some risk premium, which is going to provide you with some kind of buffer against any pickup in volatility in the Treasury market. And I think if you believe, as I do, that we are going to move into a somewhat higher inflation regime, that the sort of lowflation regime that's dominated global markets over the last decade or so is coming to an end, then commodities and therefore by extension emerging market debt typically do well or relatively well in a more inflationary environment. So I think emerging market debt is looking, I think, quite an attractive asset class.
Although inflation has to hit the sweet spot. It can't be too high, it can't be too low. Too high of inflation in the United States could actually be bad for some of these developing markets. So how do you determine whether we're heading toward a more dangerous spot of inflation or whether we continue to be flat in that Goldilocks zone?
Yeah, you're absolutely right, Lisa. It actually is quite a fine line. I mean, I do think that if we are moving into an environment where inflation is, particularly in the US, is sort of in the range sort of 2 to 4% going through next year and beyond, then I think that's actually an environment where it's as you sort of suggest, that kind of Goldilocks to some degree. If we get a more serious and sustained rise in inflation, which then forces the hand of the Fed to be much more aggressive, not only in terms of tapering its QE, but also then in terms of bringing forward when it does lift off from zero rates and where ultimately rates end up, then we're in an environment where not only do you have higher inflation, but you've got increased growth risk as well. And that clearly is going to be a negative for a lot of sort of growth sensitive risk assets, and emerging market debt will be part of that. So you have to kind of track the data and make those judgments in terms of your portfolio construction.
So David, I am curious though, I mean, in past economic and monetary policy cycles, we tended to see a lot of central banks follow the Fed. They would wait for the Fed cues. This time around, we're not necessarily seeing that. We're seeing a lot of banks start to either move forward with some sort of normalization, or at least start to talk about it in a way that we haven't yet heard the Fed talk about. Why?
Yeah, I think it's a good point. And I think the reason we're seeing that is that some of the central banks, whether the Bank of Canada, the Reserve Bank of New Zealand, are starting to sort of say, even the Bank of England to some extent, are starting to sort of signal that they have more confidence in the recovery, and that it's time to at least be thinking about, or about scaling back the degree of accommodation, even if it's not outright tightening. I think one of the reasons we're not seeing that from the Fed is because the Fed has changed its monetary policy regime. Has moved to this average inflation targeting regime. And I think it's going to be very, very hard for any central bank, frankly, to be more dovish than the Fed is. And I think that's one of the challenges that's facing the ECB, even though Europe, I think, is in a less good place than the US is in. And why I think, we've seen some of this dollar weakness over recent weeks.
David Riley, is dividend growth and use of cash for dividend growth, is that a yield alternative right now, given where real yields are?
It is the case that you can start looking at sources of income from the equity market. I mean, what we know, of course, is that dividends aren't as reliable as coupons. They do get turned off or switched off, and you have to kind of factor that into the analysis that you're doing. I mean, I think it is the case that it still makes sense to have as part of your portfolio clearly some core fixed income, because it's a significant dampener to the overall volatility of your portfolio. But where you're looking also to generate some additional income, you have to kind of go off benchmark, if you like. So that would include emerging market debt, but it would also include things like leverage loans, collateralized loan obligations, where you're getting a yield pickup, but you've got relatively little in the way of interest rate risk embedded in the instrument.
David, hearing you talk, it sounds like you're risk on. It sounds like you are very optimistic about the global scenario, and yet recently you've been reducing risk on the margins in your portfolio. Where and why?
Yeah, I mean, I am optimistic about the outlook for the global recovery, the sort of global reflation story. the reason, and that's why we still have this pro-growth bias across these strategies at Blue Bay, but we have brought down some of the risk, and really we've done that because of valuations, not because we have concerns about the fundamental outlook. It's because a lot of the good news that we're expecting is frankly already in the price. And you can see that, for example, when you look at sort of generic credit spread. So, you know, the sort of symmetry or the asymmetry, if you like, around the upside versus, you know, we get a bout of volatility, uncertainty around the Fed if we get a big inflation print on Thursday, for example, is such that it makes sense just to sort of dial down the amount of risk within portfolios.
David, thank you so much. David Riley there, particularly on capturing the yield with Blue Bay Asset Management, their chief investment strategist. Lisa, just to me, it's just still shocking where real yields are, and we heard that focus with an earlier guest on the 5-year real yield. Yuri and Tim are looking at that.
The interesting thing is that we've kind of seen an unwind of inflation expectations. We saw a huge surge up, and then you've seen this unwind of it, which has led stability to the market, saying that we're not going to necessarily see destabilizing inflation. And yet you still have big thinkers coming out and saying, you know what, this time could be different. And to me, this is sort of setting up for a real pivotal next couple of months as we get increasing numbers of data points.
Romaine, where are you on this? I mean, the fact is the big and the little watchers, they make up the market.
Yeah.
We got two markets. We got people talking inflation, worry, surprise. And the fact is they got the yield where the yield is.
Yeah, and you look at the inflation expectations as priced into the market, and frankly, they aren't a whole lot higher than what the Fed's target is right now, and it really hasn't moved a tremendous amount over the past few weeks here. I think the general consensus is that people are buying into the Fed's message that a good portion of this, not all of it, but a good portion of this is going to be transitory. I think the key thing to watch, and what we're hearing from a lot of strategists, is really wage inflation, Tom. That's the sticky one, and if that ends up going higher, then I think you could have some concern here.
Red and green on the screen with a VIX stunning 6.68. We had a 15 handle on VIX here moments ago. Stay with us on Apple. Must watch, must listen next.
With the First Word News, I'm Ritika Gupta. U.S. Treasury Secretary Janet Yellen says higher interest rates would be a plus for the U.S. and the Federal Reserve. In an interview with Bloomberg News, Yellen said President Biden should push ahead with his $4 trillion spending plans, even if they trigger inflation. She says any spurt in prices resulting from the rescue package will fade away next year. Some of the world's biggest tech companies are welcoming the G7 agreement on a minimum corporate tax rate of 15%. Facebook says it's a first step towards certainty for businesses, and Amazon says the process will lead to stability in the tax system. The agreement is designed to help countries impose taxes on tech giants such as Facebook and Amazon, but it may not be implemented for years. Google will pay $268 million to settle an antitrust investigation in France, and it's agreed to change the way its business works across the world. France's antitrust agency said that Google used its dominance over ad sales and purchasing on its platforms to distort the market, hurting rivals such as Rupert Murdoch's News Corporation. And a couple of big deals in the news today. Blackstone Group has agreed to buy data center operator QTS Realty Trust in a deal valued at $10 billion, that representing a 21% premium to QTS's closing price on Friday. And meanwhile, Macquarie Infrastructure has agreed to sell Atlantic Aviation to KKR. The deal values the airport services company at almost $4.5 billion. Atlantic Aviation offers hangar space, aircraft maintenance, and other services. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It is a relationship in trade that has been marked by significant imbalance. I would say that there are parts of this trade relationship that are unhealthy and have over time been damaging in some very important ways to the U.S. economy.
Very good. Catherine Tai, the U.S. Trade Representative there, moving the dialogue forward. We welcome all of you to Bloomberg Surveillance. Massive correction in order right now. I was back 20, 30 years at 82 Devonshire Street with Uri and Timmer. We must surveillance correct to the new Fidelity Manse out by the old Gillette factory at 245 Summer Street is where the Timmer chart room is at Fidelity. Thank you for commenting on that. We were like launching into it's farther from Fenway Park. That's all you got to know, Lisa.
Serious correction.
There's serious correction this morning. Lisa Abramowitz and Tom Keene with Romaine Bostick. Thrilled that you're with us this morning.
Thank
John
you.
Farrow is off right now on Apple in a controversial call on Apple. Pierre Farragut is with New Street Research. They do the soiree today. A lot of people are more optimistic. Pierre, you really push against the optimism on Apple. Why?
Well, that's thanks, Tom, for having me. That's actually really a question of the flip side of Apple's success in the last 12 months. So the company is on its way to ship 230 million iPhones this year, right? So that's the success of the iPhone 12, the first 5G phone, a phone that is selling at the point in time where most, affluent consumers have been like stuck at home, not traveling, not going much to the restaurant. So, but still making about the same amount of money, sometimes even a bit more. And so these consumers have been spending a lot of money on high-end consumer electronics, and this has benefited the iPhone very significantly. And now, what we always keep in mind in our research is that Apple is playing on a fairly closed garden. There are so many iPhone users. And so when you have 230 million of them buying a new phone in the last year, that creates a sort of a depletion in the market for the next year. And so what we anticipate happening is that the next iPhone lineup, the 12S, is probably going to be not as innovative as the 12 relative to the previous one. And then you'll have less people in the market with an older phone and more people in the market with a newer phone. And then last but not least, people will get back into restaurants and like rebalance their spending profiles. So the combination of all that calls for a very weak year for the iPhone from the fall of 2021 and into 2022.
How does the monthly plan concept change the refresh rate dynamics? The idea that you're not putting $600, $700, $800 up for a phone, but they rope you into some form of monthly plan. How does that change this guesstimate towards a bearish Apple call?
So that's a very good question, Tom. And I think the simple way to look at it is to look at it as a finance purchase. It's like taking a small loan to buy your phone. So a significant portion of the market is going to be triggered by their refresh plan. So they will actually take the opportunity of a plan coming to its end in order to buy a new phone. At the same time, what you'll see is that a lot of them will actually be also in a mindset of you don't really have plans. There's a very small minority that will replace your phone every year. It's usually every 2 years or even every 3 years. And so when that happens, what you can see is that a lot of consumers, and when I say a lot, it's a small portion, it's maybe 10, 15, 20% of consumers will actually play on the timing of their replacement, waiting for the next phone, or taking an opportunity to change their plan, to go to a cheaper plan and things like that. So there is a lot in the iPhone market that is, I would say, in which there is a rhythm that comes from this contract. But at the end of the day, a very large portion of iPhones are still sold, independently from a plan. It's still like on a global basis, more than half iPhones are sold independently from a plan as well.
Considering the importance of Apple to so many portfolios, the idea of a 28% downdraft in the shares. And I'm wondering what the path is that you see getting there, given the incredible ownership and the incredible appetite for companies that have pricing power and incredible cash flow.
Yeah, it's a very good question. So I think what you'll see is that we are still like in fairly uncertain times. And so when you start having negative news flow about iPhone commercial momentum, you will have some sort of profit taking on the stock, knowing that profit taking on a more than $2 trillion market cap is kind of almost an absurd concept. It's going to be marginal, but prices move when there is a change in balance between marginal demand and marginal supply on the stock. And if you start hearing, more and more news flow suggesting Apple is not going to have a good year, then you have more and more owners who were significantly overweight that will move slightly less overweight or maybe equal weight. I would expect very few of them will go underweight. And then if people see a 20 to 30% decline potential in the stock, they'll probably stay on the sideline and wait. And then of course, like people buying the weakness will take some time to come in. And then there is another element that you need to take into account, that you still have a lot of money that is managed market neutral. And so a 20 to 30% decline potential in such a large cap is an excellent funding short. So you could expect to see, if things play out the way we anticipate them, a lot of long short money actually taking positions from that perspective.
Any possibility here for, I guess, a pivot or any sort of real innovation here? You're talking about 14 years now since the iPhone, 11 since the iPad. Tim Cook, of course, been there for 12 years. Very quickly here, Pierre, what's next? So it's a lot of things that are very exciting on the horizon of Apple, but none of them are really like on a one-year horizon, and we'll see what they announced today. But the things that are very exciting for Apple, I think, is like the evolution of the hardware portfolio towards a setup that will, enhance, like make possible augmented reality. So Apple coming up with a headset, with a pair of glasses, with more and more devices that can communicate to each other, position each other against, position themselves against each other. And that, I would say, is a 2 to 3 year horizon. And then, of course, my background and the interest I have on Tesla and on electric cars, and self-driving cars. And I think that is a monster opportunity for Apple, but it's still very open-ended and multiple years away.
Pierre, we're going to leave it there. Pierre Ferrago, New Street Research, just fascinating. As Lisa mentioned, an outlier call there with some real tangible caution on the iPhones. Lisa, what will you look for from Apple today?
Whether they actually have a real new product that could attract the likes of the Keene household to shell out $1,000 on a new orange iMac.
I think they're going fancy. I think it's like maybe they'll have a new chip today. Seriously. Yeah.
Well, that actually would be huge. Or manufacturing their own chips.
Yeah. Red and green on the screen. Stay with us on radio, on television. Good morning.
Most people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người, bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years, from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Good morning, everyone. Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom King. Thrilled that you're with us. Mr. Farrow is off in Romaine Bostick holding court with us. Coming up, a really, really important moment on work from home. This will be required listening in about 15 minutes. Right now, and with great insight, Neil Dutta joins us through Renaissance Macro. This with green on the screen here. Futures, well, a little up fractionally as well. 16.86 on the VIX. Neil Dutta tears apart what we learned about the American labor economy on Friday, and driving forward what we learned about when we get to the vaunted 1 million units. Neil Dutta, what did you do to your x-axis off the jobs report on Friday? How much farther out till we see tangible labor recovery?
Well, you know, it's a great question, Tom. I mean, it's coming a little bit slower than I would have hoped. And obviously, we got a head fake with the strong ADP number heading into the Friday jobs report. But I think over the summer, we should begin to see stronger employment growth. You know, what the issue right now is not demand, in my view. We know that job openings are quite high. We're going to get more evidence of that later this week. The issue is one of supply. You know, prime age labor force participation rates haven't moved since last summer. And during that time, job openings have grown by over, you know, like 2 million. So this is primarily an issue of supply. It's binding in the short run. And there are issues around why that may be the case. I mean, I think COVID is still an issue. I mean, you still had as many people saying that they had a job but weren't working because of illness as you did in May, as you did in March. So despite this drop in cases, you know, COVID remains an issue. I think child care is probably an issue. And I also think the unemployment insurance issue, which is the most contentious of all of these things, is probably an issue. And we're going to get a good test case over the summer. I mean, if jobless benefits, supplemental unemployment insurance goes away, then that should prompt more people
Right.
to kind of attach to work.
I thought Heidi Shearholz with the Economic Policy Institute was really good in the New York Times, very thought-provoking, Neil Dutta, about just the idea of, well, between the demand and supply of labor, just raise the wage. Will the raising of wages be demand pull, or will it be cost push?
Well, I mean, it's not that. I mean, yeah, that's fine. But are we're going to celebrate this sort of boom in low wage wages? Wasn't the 2019 period? I mean, obviously, this was all happening before the pandemic too, right? We were talking about leisure and hospitality workers getting a lot more. Wasn't that a much better outcome for the economy? So I think it's a little bit premature to be celebrating this. Obviously, if restaurants are going to give out bonuses to workers to kind of join, that doesn't stop those that are already working at restaurants from also taking bonuses to go join somewhere else. Does anyone really believe that's a good situation for the restaurant industry? And what do you think that's going to do to future employment opportunities in that industry? I don't think it necessarily be the best thing. So, I appreciate the fact that low-wage workers are getting more. I think that's probably a good thing. But the dynamics of what's happening now with the shortfall in that industry being so substantial. Remember, that's the industry that's seeing the highest rate of wage growth, but also has the biggest shortfall in employment relative to the pre-pandemic level.
Neil, there's a controversial issue here of whether higher wages actually slows growth meaningfully or actually leads to a fewer number of jobs, and how that sort of feeds back into the economy. But there is a question also about how much these frictions are going to slow growth over the longer term. I mean, at what point do these frictions, do the incredible demand for workers paired with the lack of supply lead to a slower growth scenario for you than you otherwise would have said?
I mean, you're seeing that already play out in the short run, aren't you, Lisa? I mean, look at auto sales, right? You can't buy what you can't sell. And that's true of housing as well, right? I mean, so it's already starting to bite. The good news, of course, is that, service sector consumption is continuing to accelerate in a pretty linear fashion. So, we're talking about restaurants. It's important to note that, restaurant dining out is still sort of growing at a solid, pace. I mean, that's kind of offsetting some of the slowdown in these goods industries. But supply is binding in the short run. I mean, it doesn't respond as quickly as demand does, and you're beginning to see that. The question is, are these issues going to get better or worse over the next 3 to 6 months? And I think it'll get better. I mean, COVID is the first issue. We know that that's going to get better over the summer. Cases are going to continue to decline, and that should make people more comfortable about taking work, especially those sorts of jobs that require, face-to-face contact with people. Schools are going to reopen. In New York, where I live, for example, they've said that it's going to be a full in-person instruction. That's got to help the labor situation.
Sure, and we're all excited. I'm telling you, as somebody also who lives in New York with children, we're all excited to get them back into in-person learning. There is a question, though, just going back to your point about wage inflation and the sort of frictions here, and we don't know how long-lasting it will be. Bank of America put out research showing that wage inflation was already back to 2001 levels when you looked at durable manufacturers and the amount of jobs they had available versus workers that they could rehire. At what point do you take note of that? Could we see wage inflation that actually leads to slower growth that causes you to actually materially change your outlook?
I mean, you're seeing it in certain sectors, but I guess the issue for me is this a permanent state for the labor market, or is it temporary? I'd argue it's temporary because I think the supply shortage in the labor market is temporary. So, these headlines you're seeing about, restaurants or fast food dining handing out iPhones to teenagers for them to come work, or even what you're citing in the durable goods sector, that is not a permanent state of affairs. What we're seeing in the labor market in terms of what's holding back supply is is largely temporary in nature, which means the constraints that you're seeing, these sort of things that you're pointing out, will also be temporary in nature.
All right, so let's assume that this does end up being temporary. Based on that belief, based on the data that we've gotten so far, Neil, you have to believe that Fed tightening then is still a little bit far afield here. You still buy into that general thesis? Do you buy into what Powell has been telling the market?
I do. I mean, the Fed's policy is to let the economy run hotter than any of us have ever seen, at least, I mean, at any point in our careers. And it's their policy to be somewhat irresponsible. And to me, that just means that, against traditional benchmarks, they're going to look like they're going a lot later than they otherwise would. And I think that's going to be interesting for the markets because it probably means that once they start, they'll go a lot more rapidly. But I do think that they wait a lot longer than they had been in the past. I mean, a lot of people are talking about the Jackson Hole period being a kind of setup for tapering and all this.
Yeah.
I don't know. I mean, I know that's the consensus, but they've made some progress, but have they made substantial further progress? I mean,
Right.
that still feels a ways off. And remember, they're defining this also not just in demand side terms, but supply side terms. Are they gonna start thinking about stepping to the exit door with the labor force participation rate basically unchanged since last summer? Remember, it's almost 2 percentage points below where it was right before the pandemic. I mean, and we know that before the pandemic, the Fed was sort of buying into this idea that, their policy, basically letting the cyclical recovery ensue, would it in and of itself help the supply side of the economy by drawing people into the workforce? They were talking about that before the pandemic.
Right.
So why would they kind of signal some kind of an exit with the labor force participation rate? I mean, that to me that's the risk, right? Is that they have this policy where they're not just looking at demand side issues, but they're looking at supply side issues.
Right.
And that can get interesting from a future inflation perspective. So I don't think these are issues right now, but you could see this sort of playing out in the years to come.
Absolutely, but there's still risk in the messaging as well. I mean, whatever sort of weight we're putting on Jackson Hole, the general idea here is that Powell's still got to get everyone on board for actual action itself here. And I guess I wonder whether the messaging that we've gotten so far is consistent, or at least, I guess is consistent, with what the market is willing to accept.
Yeah, I mean, this goes back to the cacophony of Fed speak, right? I mean, I generally think that he has the board of governors on board with his strategy. The hawkish folks are generally regional Fed presidents that don't really have much bearing on what the actual policy outcome is going to be.
Dada, thank you so much. Greatly appreciated. From Renaissance Macro this morning. He's just been really, really brilliant on the supply and demand dynamics of the American labor economy. Romain, what do I make of this? I got a lift in the market. I mean, what's the why?
I'm not sure what the why is. I mean, you're talking about 0.1% here on S&P futures.
Go with us, Romain. It's the morning.
I don't know. There's something about a pendulum. I don't know. Bezos is going to space. Maybe that's the catalyst. Who knows, Tom? But what we do know is there's that bid that's been coming into this market. It has been persistent. It may not be spectacular. It may not be your 100% AMC type of bid. But there has been a persistent bid to the upside here on this market for the past few days here. And that appears to be continuing here, at least on this Monday. I don't know. Maybe call it clarity. We'll come up with a narrative after the.
I haven't even brought up my meme stock this morning. AMC 49, up $1 roughly pre-market. I mean, I don't know. Lisa, what do I make of how memey are we this morning, Lisa?
Well, we go to cash. No, I'm kidding. I mean, honestly, I think that the fact that we've seen a return to the meme stocks just highlights how we've seen some of the frothier areas of the market regain steam. I personally, the narrative I would give this is we saw an unwind of the inflation narrative. And now we have this belief in the Fed that the Fed will get what they want despite some of the naysayers. Question is, will that last? Coming up, we're going to be talking about that and much of the action that we expect to see throughout the day. Woody Cesar, Wells Fargo Securities Head of Credit Strategy, joining us. We'll be sure to talk about the Fed, their holdings of ETFs. I know, Tom, you were really interested in that.
I'm on top of that, yeah.
Look, I personally find this fascinating, the idea that if you have faith that the central bank has your back as a company, what does that mean in terms of your willingness to take on risk?
Right now, the 10-year yield 1.57%. I'll tell you, 156 would be remarkable. That is an adjustment off the jobs report that we saw. We're going to continue forward. We have a superb moment coming up with Nicholas Bloom of Stanford. For any of you considering the new work, this is must watch, must listen. This is Bloomberg. Good morning.
With the First Word News, I'm Rishka Gupta. U.S. Treasury Secretary Janet Yellen says President Biden should go ahead with his spending plans, even if they lead to more inflation and higher interest rates. Yellen told Bloomberg News that higher rates would be a plus for society and for the Federal Reserve. She says any spurt in prices resulting from the rescue package will fade away next year. In Mexico, President Andrés Manuel López Obrador's party took the lead in midterm elections for the lower house of Congress, but a survey indicates his coalition won't retain a supermajority needed to pass constitutional reforms. In Peru, the presidential runoff is still too close to call. Investor favorite Keiko Fujimori trails leftist Pedro Castillo. Fujimori is the daughter of jailed former president Alberto Fujimori. And New York oil dropped after hitting $17 a barrel for the first time since October 2018. Still, the outlook for demand remains bullish as vaccination rates accelerate, driving greater mobility. Oil prices are up more than 40% this year. And shares of Tesla are lower pre-market. The electric car maker called off plans to build a Model S Plaid Plus. That's the longer-range version of its high-end sedan. Tesla CEO Elon Musk tweeted that Plaid Plus will be cancelled because the Plaid version is, quote, just so good. And the world's richest person is going into space. Jeff Bezos will be one of the passengers next month when his company Blue Origin sends humans into space for the first time. Bezos and his younger brother will join the winner of an online auction the company is conducting. The suborbital flight is set for July 20th. That's 15 days after he is set to resign as CEO of Amazon. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
We still going to have to remember that, the economic hit to the economy, to jobs, back last March, April, and May were devastating in a lot of ways, and we can't just flip a switch. But this is a positive report. Certainly, I would love to be able to stand here and say 7 million jobs came back, but unfortunately, that's not how the economy works, and that's not how the system works right now.
The Secretary of Labor is spirited there after the job economy report. It'll be interesting to see if we get a number of improvements in the report, how the tone will change from the Biden administration. This conversation has been hugely anticipated, and it does so because Nicholas Bloom, as a young student many, many years ago, was at the absolute forefront of labor dynamics, innovation, and technology. He did this with someone that's been of such help to Bloomberg on the Economy and Bloomberg Surveillance, the great John Van Reenen. And we're thrilled that Nicholas Bloom could join us from Stanford this morning. Professor, congratulations on your January 2021 paper, which is the discussion point on work from home. I want to go back to Bloom, Kretschmer, and Van Reenen of 2009. And what has changed is the technology has changed. Is the new technology the reason work from home will work?
It's been a very odd journey. So, as backdrop, I've been working on working from home since, I think, 2004. I mean, that's almost 20 years now. And it was normally a quiet backwater topic until, of course, March 2020, beginning of the pandemic, when it just went wild. It has changed a lot. My experience of working from home, the last 10 years have been kind of different because basically we got the two final critical pieces. We have video calls. So we can do this. We can have talks and Zoom and Teams over the internet. And we've had Dropbox in the cloud so you can share files. If you go back 20, 30 years, I talk to people that, do working from home in the 80s or the 90s. It was terrible. It was telephone calls and dropping off piles of paper at the front door. If the pandemic had happened in, say, 1980, we would have been in real trouble. I mean, we couldn't have worked efficiently. I'm not sure what the lockdown would have like. Thankfully, we had the ability to flip roughly 2/3 of the economy in March 2020 to working from home. It worked pretty well. In fact, it looks like a lot of that's here to stay.
Well, but is there a permanence to it? And let's go back to the hallmark. You did the paper with Van Reenen and Kretschmer in 2009. Marissa Mayer changed the world at Yahoo in 2012-13 with a great debate about Yahoo work from home. Drag that forward now to where Nicholas Bloom and Marissa Mayer can say there's a permanence to work from home, or like Marissa Mayer's, people would say, let's get into the office. Which is it?
No, I spoke to Marissa Mayer recently about this, and I think what she did is exactly right, but history's kind of forgotten what she did. So just to be clear, Marissa Mayer discovered that there were people that were working home full-time, and some of them were like working so poorly they'd never turned on their computer for more than over a week at a time. So she said, look, A, you're going to have to come in, let's say 3 days a week. You can't work from home full-time. You're going to come in 3 days a week, and B, we want to monitor you and manage you and make sure what's going on. You're getting your job done. But huge numbers of firms are rolling out exactly this plan now. So you hear, Citibank and Apple and Google and Microsoft and HSBC, et cetera. The world is copying exactly that plan now. They're saying, look, post-pandemic, you're going to come in probably 3 days a week in the office. Let's say Monday, Tuesday, Thursday. You work from home Wednesday, Friday, and we're going to manage you. We're going to check up on you and make sure that what you're doing your job. But as long as that works, you can continue that indefinitely.
All right, so that gets right to the idea here, Nicholas, about productivity and I guess the perceptions of productivity. A lot of companies, they want to look over your shoulder and know that you're doing the work that you're supposed to be doing here. What is your data showing here about the level of productivity during the COVID crisis with everyone at home?
Well, quite surprisingly, working from home appears to be slightly more productive than being in the office. So that's based on survey responses and on some data we've got on a few individual firms. My concern, and most firms' concern, is that won't last forever. So we kind of entered into the pandemic with this stock of what you might call social capital. So we've been in the office for years together. We knew each other. We've been creative together. I don't think that can last forever, what we're doing right now, working at home 5 days a week. So on productivity, the reason firms are going back is hybrid seems to be the best for productivity. You spend 3 days in the office, social, all your meetings or your team events or your client events are there. 2 days a week, quietly working at home when you save the commute and you actually do better at quiet time. So it looks like that maximizes productivity. And employees love working from home hybrid. They love to get 2 days a week at home. So this is why this plan has been so universal. Is this really the best of both worlds? Firms are more productive, and we as employees are actually happy.
Well, what about career advancement? Another criticism of the work from home movement is this idea that you need that face time. If I want to move up in my career, I need to be face to face with Tom Keene every day so he doesn't forget that I exist.
Yes, exactly right. So again, the thing I've spoken quite, vocally on, and it's been somewhat controversial, is career advancement is fine as long as you are coming in the same number of days as the people you're competing against. So look, if I'm in a team of 10 people and I'm at home full time and the rest of them are coming in, 3 days a week, you can imagine I'm going to get left behind. As long as the whole team comes in on the same 3 days and stays at home on the other 2, things are good because you're compared with people who are doing the same type of work schedule to you. No one's getting ahead with the boss because we're all coming in for the same number of days. So the big problem is firms that are going for this choice plan whereby they say, as long as you're doing your job, you can choose the number of days you come in. You can imagine that, down the road it's going to be very problematic. Some people come in 1 day a week, some will come in 5, and those that come in 5 are going to get promoted and move ahead.
Nicholas Bloom, thank you for an early morning in Palo Alto. And Professor Bloom was Stanford at University. I really can't say enough about his January research on this raging debate of work from home. What do you think, Romain? Can we do surveillance work from home?
We could give it a try here, but I mean...
We did give it a try. Trust me, it's better in the office.
I remember that. Yes, it certainly is, I think, for folks like us. But look, I mean, to Nicholas's research, I mean, he makes some great points here, not only about the productivity side of the equation, but really about the work-life balance, and that there are sort of benefits, tangible benefits to the workforce by having that flexibility, even if it's just 3 days a week at home, maybe 2 days in the office.
I'm going to stay out of the debate, but I'll tell you, it's a huge debate right now. For those of you across this nation, and particularly if you're not in a job economy where you can work from home, in the work from home space, there really, to me, Romain, there's really no topic. There's no other topic.
Yeah, absolutely. And we should point out, I mean, this sort of applies to a very privileged class of folks out there, and there are a lot of folks that don't have that opportunity.
Yeah, I think that's really worth stating. There's been some really good work on that. I nod to Heidi Sherrills and Economic Policy Institute for some of their work on that right now. I also nod to green on the screen. Futures advance up 4. That's a big move off of where we were 3 hours ago. Dow futures up 76, the VIX 16.80 in this great bull market. Let us not forget Apple with some big announcements. What am I going to look at as an Apple nerd? I'm really interested in the chip technology of the M2 or the M1X, whatever it is, because that's what leads the way. Romain Bostic and the rest of our afternoon crew with Apple discussion here this afternoon. On Balance of Power, the former Citigroup vice chairman and New York City mayoral candidate, Ray McGuire.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Minutes till the open. Bleeding higher can't keep a good market down. From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, investors balancing stimulus optimism amid rising rates and inflation concerns.
The US are being a bit confusing here. Threats of interest rates. You've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing.
Punch is actually spilling over the sides. Still awash with excess liquidity. The Fed is just putting so much liquidity into the system.
The rally comes because the Fed is pumping money into the system.
Extra fiscal stimulus in the US economy.
Fiscal stimulus and monetary stimulus is still there.
You can't balance off those two. You've got the Treasury giving an interest rate forecast.
Maybe that pushes the taper conversation to Jackson Hole in August.
The Fed, for the time being, is going to be relatively cautious.
It's not the same as what Janet Yellen is saying.
The overall balance of financial conditions.
It's inevitable that conversation has to happen.
Are we too sanguine about inflation, or are we perhaps overly concerned? Joining us now, Winnie Caesar of Wells Fargo, Luke Kawa of UBS. Winnie, I want to start with you. Where do you fall on this as we rejigger the conversation? And it seems as though, in some ways, inflation worries have been unwound from a lot of markets.
Hi, Lisa. Thanks so much for having me today. I think that you're right. It's been a really interesting move in the rates market, especially as we've seen some kind of underwhelming payrolls and employment information come through. And I think that investors really looked at the recent inflation prints and looked at the really significant moving pieces that were driving inflation higher and kind of looked to those things and said, well, you know, perhaps used cars increasing at 10% year over year is probably not going to be a sustainable thing for an extended period of time. And so we've really seen this violent reaction in the rates market. And for credit, that has meant a lot of stability overall as investors continue to figure out, where am I going to put my cash to work so I can generate some sort of income over the foreseeable future? And really maintaining kind of a positive view on corporate credit is very much predicated on all of that liquidity and excess cash that's going to take a lot of time to absorb, even if we see inflation.
So, Luke, we seem to have moved from transitory, which has become a drinking game on Bloomberg surveillance, to persistent. Is that right?
Well, I'm not quite sure we can make that jump yet, and it's because of what Winnie was essentially talking about there, that we do see that some of the factors driving inflation now are likely to subside. However, on the other hand, what's going to happen with shelter inflation, with OER over the next 6 months to 18 months, and that's where we see kind of this ability for, by year end, the inflation upside risk story and this transitory versus persistent debate to still be ongoing. So the drinking game should continue well into year end in our view. And that's because, in part, a lot of the methodological differences between CPI and core PCE. So even if energy prices just essentially do nothing, they're going to be still contributing to some good solid headline CPI inflation over the course through year end. Yeah. And at the same time, we do see the lagged effect of last year, the rental inflation and housing inflation really starting to trickle through. At the same time, that core PCE is really decelerating. So by year end, the Fed's going to be able to say, hey, look at this trend in core PCE. Like, we're right. It's transitory. Aha, we win. Market-based measures of inflation, if they're focusing on headline CPI, are still going to be able to say, well, this might be a little uncomfortably high. This is still higher than we expected. Maybe there's still some cause to say that you're wrong. Well, so we see this kind of enduring source of friction on inflation between markets and the Fed.
And Luke, just real quick here, I was looking at a metric on a 2-year basis to compare CPI and core PCE, and it actually is trending a little bit higher than the average over the past decade. What metric, at what point in the year can you actually start to make the call between transitory and persistent?
So that's what's great for us, is that we're not trying to out forecast anyone on inflation. And so we think until at least through year end, you won't be able to definitively make that call. And what instead we're trying to focus on is, how does the market react to an environment in which inflation is both, the risks are more skewed to the upside and the outlook is more uncertain. That's what we're trying to center on in terms of how does that inform our asset allocation. And for us, an environment of heightened inflation risk and uncertainty is conducive to U.S. dollar weakness, as long as the Fed continues to not really want to tighten in light of it, which so far seems to be state of play. And it's a playbook for kind of more pro-cyclical assets to outperform in the equity space. And I think we're seeing more the rest of the world equities start to take over from the U.S. And then that's also a recipe for, over time, more steepness in the Treasury curve, as a patient Fed on the front end allows term premium to build regarding inflation at the longer end.
Meanwhile, little progress down in Washington, D.C., with President Biden rejecting the GOP's latest infrastructure offer. Commerce Secretary Gina Raimondo weighing in on ABC over the weekend.
There's no, hardwired deadline. We are doing the work of legislating. This is a big week, so we won't do this forever. But right now, there are good faith efforts on both sides, and we're going to continue the work of, doing our job and trying to get a bipartisan agreement.
Which raises a question of what actually is already being priced in and what actually could get done. For more, let's bring in Michael McKee, Bloomberg Chief International Economics and Policy Correspondent. Mike?
Well, you're right, Lisa. This is going to be a week focused on politics more than economics, although there are a couple of important economic developments that we will be following. But those infrastructure talks do get to the critical point. At some point, they've got to decide whether they're going to work bipartisanly or do it on their own. Today, the president speaks with Shelley Moore Capito, the West Virginia legislator who is leading the Senate negotiations for the Republicans. They could reach a deal that would affect markets, but probably not. That may drag on a little bit. Of course, you know who's not talking? Fed officials. They're in the blackout period before next week's meeting. That's okay. They've got a Treasury Secretary talking for them, Janet Yellen, making news on taxes and rates. We'll talk about that in a second. The Senate does vote on a China bill on Tuesday, which would put almost $200 billion to work helping U.S. R&D and domestic semiconductor manufacturing in an effort to take on the Chinese. And we get Chinese CPI and PPI. PPI gives you an idea of what Chinese growth is like. Joe Biden heads overseas for his first trip to Europe since becoming president, to the G7 meeting. He'll meet with Boris Johnson, he'll meet with the Queen, and he'll meet with his G7 counterparts, and they'll talk about that tax deal that Janet Yellen's been working on. Then Thursday's our big day here. We get the U.S. CPI, we get the ECB meeting, and Janet Yellen testifies up on Capitol Hill. CPI is supposed to come in 4.7% for the headline, 3.4% for the core. Those would be the most since 2008 and since 1993. But take a look at this here. That was the last time we saw CPI that high, and it went away very quickly. It was transitory. Of course, we had a recession, so that may have helped a little bit with that. Though the big issue for Janet Yellen, of course, is her talk about whether or not inflation is good for the United States and rates need to go up. And you can make that case that if the Fed doesn't get rates up, they're going to have a harder time taking on the next recession. They do want inflation around 2%. The real question, Lisa, is whether or not the Fed has to raise rates too far, too fast. And speaking of Janet Yellen, there's a column out today by Bill Dudley, the former New York Fed president, who suggests that is a real danger.
Yeah, he's been more and more vocal about that. Let's talk more about those specific comments of Treasury Secretary Janet Yellen that you were talking about, Mike. What she said specifically in an exclusive interview with Bloomberg News: if we ended up with a slightly higher interest rate environment, it would actually be a plus for society's point of view and the Fed's point of view. Winnie, do you agree?
I do agree. When you look at how low rates have gotten over the past 12 months, they really are at kind of an unsustainable level. Now, for corporate credit, it has been an absolute boon because so many issuers have been able to lock in very long-term borrowing costs. Similarly, the U.S. Treasury has been able to lock in some pretty significant savings in terms of interest expense. But if we do start to see some uplift, that is pretty constructive for curves being relatively steep. That's a much more productive environment for corporate credit and for investors to be operating in. And it does give everybody a little bit of a confidence that at least that there's some wiggle room for the Fed to be able to react whenever we have whatever the next credit cycle is going to ultimately be. That's clearly a ways off.
Winnie, how much is good and how much is bad, right? I mean, at what point is a rate increase disruptive, and at what point does it send a good message that we're growing at an appropriate rate?
So I think it's all about the pace and also the outlook for the broader economy. You know, if you recall, the Fed ended up doing some insurance rate cuts at the end of 2018 when it felt like growth was not sustainable at kind of those post-tax cut levels, especially when you layer on all of the trade issues that we were having in terms of what was going on with tariffs in China. So I think that as long as we're continuing to trundle along at GDP growth that is above that kind of 2 to 2.5% run rate that we saw post-Great Financial Crisis, and then you're also seeing, you know, relatively modest approaches to rates going higher, and we're not seeing a snap of, call it, you know, 50 to 75 basis points on the 10-year in the period of a month or so, then that's a pretty constructive environment to operate in overall. But the reality is borrowers have a lot of cushion against rates going higher, given how much they have really termed out very low-cost debt at this point.
I gotta say, Luke, the more that I see the market response to potential talking about tapering at a time when we're talking about GDP at such massive paces, I wonder if the Fed really can extricate themselves gracefully from their policy and raise rates in a way that Janet Yellen calls productive for society. What's your view on that?
Well, to kind of back and kind of frame this, what Janet Yellen's actually saying in terms of the higher interest rate environment being positive, what she's really saying is the experiment she wanted to run about running the labor force hot to try and get essentially labor force participation up, that leading to higher trend growth, that's a good news story. If the pandemic ultimately turns out to be a positive productivity shock, that's also a good news story. If the higher interest rate environment is also a function of a better growth policy mix abroad, also a good news story. So add all those up. Janet Yellen just, you know, I think essentially stating facts on what that is. You know, how do we get there? As Winnie pointed out, is the question. And I think the Fed's messaging and rhetoric, I think the thinking about and talking about has been one of the most brilliant evolutions in Fed communications in decades, because it just introduces this slow gradient into how we're talking about the removal of policy. And to the point that Mike raised about Bill Dudley's outlook and that column, this was always the risk. We're moving from an environment where we're being forward-looking based on the Phillips curve to one in which we're focusing on realized progress. So in taking that change in the reaction function, it's always going to be the worries are moving towards having to go too fast, too late, a complete rejection of like your traditional optimal control type strategy. But right now, we're in a great position to make hay while the sun shines. Monetary policy is slated to be very accommodative for the foreseeable future.
That is the perfect phrase for 2021. Make hay while the sun still shines. Luke Kawa, Winnie Caesar, you're both sticking with us. Right now, let's get some movers ahead of the opening bell. Bloomberg's Abigail Doolittle joining us now.
Well, Lisa, we have the stock futures basically flat, slightly mixed. So let's take a look at a few stocks that are really shining and popping higher. Starting out with the shares of Biogen. The stock is climbing after climbing by 5% on Friday. This ahead of a key FDA decision on their controversial Alzheimer's medicine. If it is approved, some are saying that it's on weak data, but for a disease that affects millions, so it could net be a positive. But we won't know about that binary decision until later today. As for check-in on the hot trade of recent times, meme stocks, of course, AMC, after climbing more than 200% over the last 2 weeks, is up a mere 5%, but nonetheless, it is climbing, despite the fact fact that they announced that share offering last week. And we have some new meme stocks. Next Decade, you'll notice it is a $3 stock. At the beginning of the year, AMC, now a $50 stock, had been a $2 stock. It is up 22.5%, and that, of course, is an LNG company. And then Evofem Biosciences up 12%. Not even a dollar, Lisa, but you can see that this Reddit trade, this mania around these low-cost stocks when they start out continues. The short interest on these latest two are not even that high, about 6%.
At what point can we call them no longer low-cost? AMC and GameStop raised that question. Abigail, thank you so much. Coming up, reshaping the corporate tax environment, the G7 striking a deal to help countries collect more taxes from major multinationals. How realistic is it for this to get passed? More on that conversation still ahead. Right now, you can see a market that's not doing that much. S&P futures up barely, basically flat on the day. Red and green on the screen. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Has taken significant steps this weekend to end the existing harmful dynamic, making commitments today that provide tremendous momentum towards achieving a robust global minimum tax at a rate of at least 15%.
Secretary Yellen securing a landmark tax deal with the G7, agreeing to a 15% minimum corporate rate, new rules enabling foreign governments to go after U.S. tech giants, shedding the spotlight on tech heavyweights. Facebook executive Nick Clegg praised the accord, tweeting, quote, "Today's agreement is a significant first step towards certainty for businesses and strengthening public confidence in the global tax system." For more, let's bring in Bloomberg's Maria Tadeo from Brussels. Maria, a lot of skepticism, especially as big tech executives came out in praise of the agreement. What actually has been agreed upon, and do we actually expect to see a higher tax regime for some of the multinationals?
Well, you know, it's a very good question. So this is what we know. At the G7, they've agreed to tax digital companies. All of this is very much aimed at digital companies, at least 15%. The other thing that is key here, I would say almost more important than the actual tax rate, is the fact that it would allow countries outside of the European or outside of the United States to tax these companies in the place where they make their money. So this is not about the headquarters, it's about the sales and the operation. This is key and is crucial. Now, again, the question question here is, can it be implemented and will there be a deal? I'm told there's two things that really matter going forward. One is a G20 in July. If there's a deal on it by the summer, then it means that it's global. It means that it's truly international, and therefore it will make a difference. The other thing to watch out is make sure that that 15% stays the effective rate on taxation. Those are the two things to watch out for. You could argue it's a step in the right direction. You could argue digital companies will have to pay more, especially here in Europe, but there's still a very long way to go.
All right, Maria Tadeo, thank you so much for all of the reporting, and I'm sure there will be more reporting throughout the morning as we get more details. Back with us, UBS's Luke Kawa and Winnie Caesar of Wells Fargo. Luke, why has there not been any more reaction in tech shares to some of the proposed taxes, considering the very low taxes that the likes of NVIDIA pay versus what they would have to pay under this theoretical regime?
Yeah, I think that's been interesting. We've been asking that question a little. I think it's important to note that the growth tech cohort has underperformed year to date, and possibly some of that is trickling through into the price. Also, if you look at a basket of stocks that would be most exposed to some of the guilty or minimum tax on book income proposals that the Democrats have raised, also underperforming this year, but tough to disentangle that from the fact that it's the outlook for all the other companies, the value companies, that has improved by more. So kind of more difficult to square. Kind of we just see this as another potential headwind for the tech growth space going forward. And it's also just a reminder that as we come out of the quick recession that we had and on way to a full recovery, that the fiscal policy mix and the risks are becoming much more two-sided. And you definitely see that around the U.S. infrastructure bill. It's going to come with higher personal and perhaps corporate income taxes. And there's a real focus on going where the money is and has been in terms of tech stocks. So kind of taking a step back and looking at this from a broader market perspective. The question we have is, what does this mean for the equity risk premium? Because that's kind of been essentially around its lows of the past cycle. And for you to be confident that it can decisively kind of break through and we can be able to kind of, accept more risk in taking on equities, you have to be pretty confident that you have the supportive policy mix, both from fiscal and tax and monetary.
Winnie, from the credit side, what do you make of Luke's points there, the idea that we're heading toward a higher tax regime? How does that play into the corporate debt space?
So in the corporate debt space, the vast majority of the tech companies, particularly investment grade, are very highly rated, huge cash flow generators. And I think that one of the things that it's really important to consider is if we have a more predictable corporate tax regime and a focus more towards globalization, this actually helps reduce the amount of event risk that you have in the technology space. As Luke mentioned, having some certainty, some clarity around what policy is going to be really gives investors confidence in how they're going to put cash to work. We've been underweight technology in investment grade all year, in part because valuations are just so absolutely low, and also because we were concerned about the event risk component in terms of, issuing a ton of debt to pay dividends, do stock buybacks, pursue very large-scale transformational M&A that's highly re-leveraging. And if we can get a little bit of clarity around the corporate tax side of things, I think that some of that event risk starts to be a bit more minimal. And then we actually have some potential for some real val trades across the tech space in investment grade.
Luke, before we let you go, I've been getting some persistent messages from Tom from Bemelbins. He wants to know some important things like, can Tottenham benefit from players forming Juventus and whatever that means, and can Montreal win? So would you like to cater to Tom from Bemelbins and let him know your view on the Maple Leafs?
Ever since the new Black Monday of last week, I've taken a break. I can no longer be so emotionally invested in certain articles of clothing that pertain to sports teams. I just can't do it right now, Lisa. It's killing me.
All right, that's fair enough, Luke. Just to then wrap it up, perhaps away from that painful topic for you, I'm wondering, looking forward, what you think the most important data point will be to watch out for going forward, given the fact that you do think that it's not going to be clear until the end of the year what the outlook is.
Well, I think the market's continued ability to grapple with the decline in China's credit impulse, to me, is the most interesting and important dynamic to watch. We all knew this was the risk coming into the year. It's happening, but that credit impulse is falling in part just because nominal GDP is rising at a pretty good clip. So what we're seeing is that if you look at basket of companies selling into China compared to the MSCI world, that's down this year. But if you look at your broad pro-cyclical trade set, whether it's value stocks, whether it's expecting yields to rise, the dollar to fall, that's still holding up well. So can China's credit impulse still have more of a local impact on markets than a broad impact on the pro-cyclical trade? We think the answer is yes, and we're definitely going to continue to monitor that closely, though.
Luke Hawa, thank you so much. Winnie Caesar, thank you. Definitely an important point and many important points made. Coming up, the morning calls later, big tech coming into focus as we discuss that landmark G7 tax deal, calling into question how much they may pay. That conversation up next with Invesco's Brian Levitt and Tal Buchan's Michael Purvis from New York. This is Bloomberg.
Markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Piper upgrading Visa to overweight, the analyst citing favorable U.S. travel trends. Next up, Baird downgraded Capital One to neutral, the analyst seeing a less compelling valuation. And finally, Morgan Stanley downgrading Progressive to underweight, the analyst expecting margins to deteriorate. The opening bell up next. This is Bloomberg.
The power of Bloomberg. First on news.
Headlines crossing from Morgan Stanley to management shakeup, planning for transition in 3 years potentially.
This is a huge move over at JP Morgan. It is a shock, of course, to the market.
First on earnings.
Apple, a big beat, well ahead of the 33% increase in revenue.
First on markets.
The capitulation phase is buy.
The power of the Bloomberg terminal. The power of Bloomberg television and radio. Bloomberg has it covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the opening bell, and we have a scintillating market. S&P futures up basically a point, not even, basically flat, although up from earlier in the day. NASDAQ futures still down 0.2%. Russell outperforming. If you look at what's going on across the asset classes, you aren't seeing that much action, frankly, with 10-year yields just marginally higher. Crude having a little bit of a dip, but still near the highest level since 2018. And a bit of euro strength, but really, it is a sleepy day here in this summer Monday. Let's head to the markets desk. Bloomberg's Abigail Doolittle joins us now. Perhaps a little more action under the hood.
Yes,
Abigail.
let's, beneath the surface, Lisa, let's go where some action is. And of course, that has to do with the meme stock space, because that meme mania is absolutely continuing. Even AMC, which over the last 2 weeks up more than 200%. Wow, at session highs up 9%. Even after the company, of course, announced that greater than 11 million share offering. Workhorse also higher, up about 6%. And then there is Next Decade. I would point out again, it is a $3 stock, soaring 21%. An LNG company. AMC at the beginning of the year was $2, so you really can't laugh about that. Who knows where Next Decade will be in a few weeks, Lisa. Turning to a more macro sector, the banks. We do, of course, have yields higher. The banks rising, not in a huge way, but we have a little bit of a reflation lift there for the likes of JP Morgan, Bank of America, Citigroup, Goldman Sachs. Now, typically, when yields rise, that can sometimes pressure tech, because then there's that valuation concern. Today, if we take a look at the likes of Apple, Google, and Tesla, we are seeing a mixed bag. Apple slightly higher, of course, still in a correction from its all-time high back in January. And then Alphabet and Tesla down. Tesla in a particular down 1%. That is another company, another stock, Lisa, that has not seen an all-time high since January.
Abigail, thank you so much. Meanwhile, the G7 securing a landmark deal to revamp its corporate tax rules. UK Chancellor Rishi Sunak weighing in on the agreement.
I think the crucial thing for people to take away is the principle of fairness. That's what we've achieved today, to ensure that there's a level playing field for all types of companies. And whether it's people operating in tax havens or it's digital companies, we're going to level the playing field and inject that principle of fairness into our global tax system.
Of course, how realistic it is that we'll actually get a proposal that it goes into effect in the near future remains to be seen. For more, let's get to Bloomberg's Katie Greifeld. Katie.
Well, Lisa, that was the big news from this weekend, that possible 15% minimum corporate tax rate, and that multinationals could be taxed in countries where they make money, not just where they're headquartered. And that could pressure sectors like technology, communication services, healthcare. And this next screen, it helps explain why. The largest companies with effective tax rates under 15% tend to be tech and communication services. Apple, Amazon, Facebook all fall below that 15% threshold, and NVIDIA has the lowest effective tax rate, clocking in at just 1.8%. Obviously, that could change dramatically should this deal pass, but investors so far, they've mostly brushed off any tax worries. If you look at Goldman's basket of high-tax companies against low-tax companies, it's the high-tax stocks that are outperforming, and that's largely been the case since 2017's corporate tax cut. But we'll see if that trend holds going forward, Lisa.
Katie Greifeld, thank you so much. And joining us now to talk about that, Tal Beckin's Michael Purvis and Invesco's Brian Levitt. Brian, let's start with you. Katie was just highlighting how markets just have continually shrugged off this threat of higher taxes and also regulatory pressure. And I'm talking about big tech companies in particular. Do you think that there is a little bit higher level of concern that people should be having about the likelihood of these taxes?
Well, I suspect you may see some volatility come into these markets if policy uncertainty persists or grows larger from here. The reality is, as you mentioned in your opening comments, we don't know yet precisely what this is going to look like ultimately. I think what's critical and the big challenge that investors have is, right now there's this moment of time where the economy is recovering, some things look robust, you're getting some inflationary pressures, maybe some cyclical move higher in rates, dare we say. And so it's an environment where it broadens out market leadership. But remember what we felt like in 2018, 2019, where it was a persistently slow growth world and investors were bidding up companies that were on the cutting edge of structural advantages. And that doesn't change because of the tax regime. So it's a bit of a challenge. You may have some volatility as we assess this, but ultimately the same companies that were taking advantage of the structural shifts in the economy and society are likely to still be the big winners over time. And many of them are names that right now pay an effective tax rate that's below 15%.
Michael, what's your view here?
I tend to agree. Look, I think the big cap, the large tech companies have been and will continue to be magnets for various forms of taxation and some form of regulation. But I think you have to draw a distinction between what might be an incremental burden, to these companies' cash flows, i.e., higher taxes, or for that matter, what the Europeans have been doing with sort of, sometimes, attacking them with some fines that are large numbers, but ultimately sort of inconsequential in the broader term. I think that's very different than having something that's, there's this vague concern about having these business models truly disrupted, right?
Yeah.
And I think that's a really important distinction. So I'm of the view that these models will be largely immune to major disruption. Yeah, sure. Will some of their net income margins, contract if these taxes are applied? Absolutely there. But I don't think that really means that they're going to lose any of their sort of winning attributes and why investors, ultimately need to own these stocks, in the broader term.
Brian, what's your sense of what the risk is then for this big tech sector that you also seem to be pretty positive on, saying that they would benefit from some of the changes in society that have benefited them to date?
Yeah, I mean, the big risk that you have is policy uncertainty. And so we saw that a little bit in February when investors started to get a little bit concerned about inflation and you saw a little bit of tightening of financial conditions and the NASDAQ fell something along the lines of 10%. I mean, a market correction, which isn't out of the ordinary, particularly given the run. But I would say the risk to these companies is not, again, it's not about their business models, it's about the policy uncertainty. So we're going to have some weeks ahead where there's going to look like there's some inflationary pressures. There's going to be some concern about a Fed tightening. And so some of that is going to hit those businesses that are trading at higher valuations. I wouldn't be surprised to see that. But again, when you're thinking as an investor, ultimately, you want to decide what's the state of the economy going to be. And if the economy is moving to a new, higher structural, sustained level of growth, then by all means, the more value-oriented, really cyclical parts of the market that have done well this year will be the prolonged outperformers. But if you're like me and believe this is something of a digging out of a crisis, a reversion to the mean, and we're going to get back to a more stable, sluggish growth environment, you're going to have to pay up for companies that can grow earnings in that type of an environment. And many of them are likely to continue to be those that we've known and loved in the tech sector.
And certainly, it seems like people are buying the dip that was 0.2% with the NASDAQ nearly flat on the day at this point. Let's head back to the markets desk where Abigail Doolittle is looking at the meme stocks and other areas of rare volatility in these quiet markets.
We are certainly looking at the meme stocks. But first, Lisa, let's take a look at a piece of the reopening trade. The cruise lines are trading higher. This on the news that Norwegian Cruise Line, they've announced additional U.S. voyages sailing from New York, L.A., Miami, and Alaska cruise. Of course, contingent on CDC certification notifications, but you can see some gains here. As for the moves, the wild moves in both the meme space and the Bitcoin space, let's take a look at AMC and Naked Brand. We will see continued great gains. The meme mania continues to go on. A short squeeze, a gamma squeeze. Bitcoin, however, not so much. Now, Bitcoin itself is higher, but Coinbase down a little bit, and then MicroStrategy down 1.5%. Get this, Lisa, as I'm sure you know, MicroStrategy is planning on selling $400 million in debt to buy more Bitcoin. Perhaps not the most solid plan, so some investors not rewarding the company on the day. And then finally, to round it out, we have some retail winners. G3 Apparel up 7.5%. They put up a very strong quarter. Zumiez, the action apparel company, up also after a strong quarter. And then Chico's, Barrington Capital, is saying that they should explore strategic options. The stock is up 6.3% in response.
Abigail, thank you. And you mentioned Bitcoin. Let's talk about it. MicroStrategy founder Michael Saylor calling it the most reliable asset. Here's what he had to say.
If you're looking for a safe haven, I see Bitcoin as the most secure, most reliable, most certain thing in the entire economic universe. And if you're looking for some place where you can store your life force or your economic energy, you know, there's no real question.
Brian, do you agree? No real question. It is the only and the most stable of all assets.
Well, it certainly hasn't behaved as such. I mean, I know there was a lot of interest once Bitcoin got above 50,000 and 55,000. I know some people buying it at 58,000. So, you know, that waking up this morning, wherever we are, 37,000 or so, I'm not sure if those investors have felt that it's the most reliable. I mean, my message is that, you know, it's still speculative in nature. You know, there's significant volatility embedded in the asset class. You know, to the extent that investors want to participate, they should make sure that they understand the level of volatility that they're bringing into their portfolio. I think, you know, far too often we're seeing a sort of all or nothing from investors. Make sure you understand the volatility. There may be a place for it in the portfolio, but make sure you're not going to extremes. And, you know, as far as secure, safe asset classes or even currencies, I mean, look, the US dollar has been a very strong performing currency for a very long period of time because the United States has been a stalwart with regards to growth. Now, a little bit of weakness recently given all of the stimulus that's been brought to the market, but over time, the US dollar has been a very stable, as have US Treasuries, a stable asset class. So I don't think I'm ready to coin, pardon the pun, Bitcoin, the most stable asset class yet.
And Michael, I assume that you would agree. And I guess that I'm wondering, though, how important it is for you every day to look at Bitcoin, to give you some information either about market trends or, frankly, about that asset class's haven appetite.
I mean, I think you always have to kind of look at it, but I do look at it as sort of peripheral to what's happening in the broader equity markets and rates markets. You know, if Bitcoin went to 5,000 tomorrow, of course, it would drive a lot of drama, but I think ultimately more traditional assets would kind of shrug it off. There's clearly it would be a wealth effect. I will say one thing here. You know, I put out 2 bearish notes on Bitcoin based purely on technicals earlier this year. You know, I think, you know, with this crypto conference in Miami just finished, you know, one question remains, which is that institutions are really key to lifting Bitcoin up into the $50,000 to $60,000 range. And I think right now, if I were running, you know, an endowment or an institutional investor, I think you have to really step back and think about, okay, if I want to be in the digital currency place, do you want to be in Bitcoin? Do you want to be in Ethereum? I think there's a lot of questions here. So I think from a short-term point of view, we're seeing it, you know, 35, 36,000. For it to get back to 50,000, 60,000 and beyond, it sort of feels like you need a really big catalyst and more endorsement from the institutional side. And I just don't know whether institutions are ready to, I mean, to really commit that way if they really have to think through their questions. Do you want to be the guy who ran to your committee saying, yeah, let's get, you know, load up on Bitcoin here, and it was the wrong coin to load up on?
That definitely, I'm sure, is a concern for some. and yet we do have more and more institutional investors coming out and playing around on the margins with Bitcoin. Michael Purvis, Brian Levitt, you'll be sticking with us. Coming up, the no-thrills market continuing with fears of inflation failing to rise to the surface just yet. That conversation coming up next. It is no thrills, decidedly. The Nasdaq clawing back losses, now down just 0.1%. The S&P exactly flat. And we see here the 10-year yield ticking higher a little bit, but really, what a market. A sleepy Monday. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We've sadly lost 12,000 premises across the sector as a whole. We lost about 330,000 additional staff in terms of headcount through the pandemic. It is a gradual road to recovery, but I am feeling much more optimistic. The positive response we've seen from consumers in returning to eating and drinking out, even outside, has been very welcome. And of course, we're not out of the woods yet, because we know that about 20% will struggle to reopen with social distancing restrictions, and every day that they are closed makes it less likely that they'll be able to reopen. So I think you will see continued business failures within hospitality over the course of the next year. Well, I think the government support has been unprecedented. Equally unprecedented is the hit that hospitality has taken. So we do need the government to look at a solution on rents, which is going to be critical to recovery, a recapitalization strategy to tackle the levels of debt that these businesses are going to come out of the pandemic with. So this government support, fantastic, has allowed us to maintain a large number of staff that we would have undoubtedly lost along the way had we not had furlough. But furlough actually is costing the businesses to implement at the moment, and the costs of staying closed, the industry is burning through £500 million a month in ongoing costs.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period. Whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment. And it would be quite good if we had one consistent message from the US.
The Treasury and the Fed sending mixed messages. Markets remaining on hold with yields stuck in a narrow range. Goldman Sachs backing a bet on lower bond volatility, writing, quote, with no clear catalyst in sight, a period of continued yield consolidation will mean further downward pressure on delivered volatility. For more, let's bring in Bloomberg's Ritika Gupta. Ritika.
Thanks, Lisa. Well, the summer doldrums seem to have come earlier this year after that miss on the jobs report on Friday. Well, the market said, well, rates are going nowhere. That drove equities near all-time highs and volatility slumping across assets. So many strategists saying, well, this is a sweet spot for equities, could drive them potentially even higher. If we look at the VIX, aka that fear gauge measured by S&P 500 options, well, that actually dropping close to pre-pandemic levels, dropping some 9% after that miss on the jobs. If we look at the Treasury volatility measured by the B of A Move Index, that also dropping some 8% after that miss. And we're also seeing that Q1 surge that we saw actually going back down. We're back down to February levels now. So Morgan Stanley and Goldman Sachs advising their clients to sell Treasury volatility as a measure of how much yields could move or expected to move drops to February levels as well. But as for how this Goldilocks scenario could last for, well, we get one of those indicators on Thursday, that CPI data, if we expect any surprises or not. But if you look at yields on the 10-year, they've basically been flat over the past 3 months, so really shrugging off any inflation worries. So we could expect some more risk-on sessions to come, Lisa.
Ritika, thank you so much. That's not to say that worry has completely been evaporated from the market. Former Bank of England Governor Mervyn King adding to growing inflation concerns, writing, quote, "We can't know today if inflation will rise over the next few years, but the prospect of excessive stimulus and weakened central bank independence should make us nervous." Invesco's Brian Levitt and Tal Balkin's Michael Purvis back with us. Michael, you said recently you are non-bearish on bonds, basically an endorsement of owning the securities despite some of the concern about inflation. Why?
Well, I put out this note first, March 31st, saying that the move higher in yields, meaning the 10-year yield, was really over, and that the risk return had pivoted. And it falls on a couple of things, which is that the inflation that we all see every day, you just have to walk into a Home Depot to know there's inflation, right? But that had been really reflected, in the very heavily reflected in the Eurodollar futures curve. And as those curves steepened, it was basically wholesale transmitted to the back end, meaning that every increase from the steepening of Eurodollars curves, which was a function of hiking expectations over the next couple of years, every basis point was transmitted directly into the back end, right? And so at that was really a Q1 story, and you did see rate volatility pick up as well.
Yeah.
But going forwards here, unless the Fed is really going to switch its narrative or its strategy with respect to inflation tolerance, or there's some sort of what I would call a credit premium being applied to U.S. Treasuries. Right. I just looked at Treasuries as fully priced for everything we've seen and know at 1.6%.
And a lot of people would agree, Michael. And I think that that's what you're seeing, and I think that your point here is that we have the balance of risks here and they're adequately being priced in. Brian, what could make you rethink that thesis, which seems to be increasingly commonly held across the street?
Yeah, I mean, you would have to see inflation prints that are beyond anything that we would have expected. We all know the inflation numbers are going to be higher. You'd have to see something that becomes disconcerting, something in the job market that becomes disconcerting. And I don't think it would be about the Fed moving. It would be about the market starting to price in Fed movement earlier. And so we've seen this at different times in the past, and you would have a drawdown in risk assets were that to happen. But it's not my view, and it's certainly not a base case. If I look at the bond market right now, and the bond market tends to get these things right more often than anything else. If I look at the 1-year break even, sure, it's north of 3%. But I look at the 3-year and the 5-year break evens, they're back down to, call it, 2 3/4, maybe starting to move down towards 2.6. To me, that's a very bullish backdrop for risk assets because it's telling you that, yes, there's inflation in the short term. That should be supportive for corporate earnings, as it certainly has been thus far. But then that inflation is going to start to fade, which means the Federal Reserve can go at this slowly. To me, that's a great backdrop for equities and credit.
And perhaps is the reason behind the melt-up that we see day after day. Michael Purvis, Brian Levitt, both of you, thank you so much for being with us. For some of the sector price action this morning, let's get to Bloomberg's Dave Wilson, who's been covering corporate debt. What else are you looking at today?
well, sector price inaction, you might say, because most of the 11 main industry groups in the S&P 500 are pretty much where they were at Friday's close. Couple of exceptions, real estate, the best performer on the day, up a bit more than 0.5%. And then you look at what's down and you see financial and raw material stocks off about 0.3% based on their indexes. One group that's moving up that's noteworthy is biotechnology. You have Biogen leading the group higher as investors await the decision from U.S. regulators about the company's Alzheimer's drug, aducanumab. And Biogen has actually been the best performer in the S&P 500 biotech index this year, consisting of 8 stocks. And you can see that 5.6% gain for the year, trailing the S&P 500, relative weakness in AbbVie and Amgen, which between them account for more than half of the index's value.
Dave Wilson, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, it is sleepy. Nothing happening. Fluctuating between gains and losses, waiting for something to happen and perhaps some guidance from the Federal Reserve. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is the open. Markets open. Not a lot happening, though. You got the S&P and NASDAQ fluctuating between gains and losses. The Russell, probably the most interesting area, actually building on gains. Up now 0.7%, perhaps more of an encouraging rotation back into some of those cyclicals. And honestly, though, not a lot happening outside of stocks either. Back in the bond market, yields marginally higher. But other than that, not too exciting. Time now for the trading diary, what you need to be watching this week. Apple kicking off its annual developers conference at 1 p.m. Eastern. The Treasury auctioning off $120 billion of U.S. notes throughout the week. An ECB rate decision and U.S. CPI coming on Thursday. That will be one of the key marks of the week. And finally, the G7 Leaders Summit kicking off on Friday in England. A key issue for markets right now is there seems to be an unwind of some of the inflation bets earlier in the year. Question is, how much will that give legs to the ongoing risk-on appetite given people looking beyond the Fed to the next phase of the cycle? This was Countdown to the Open. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease beside disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jivansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jivansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.